Hey everyone, and welcome to today's Explainer. We are going to completely flip the script on how you think about building true wealth. Today, we're moving way beyond the math, the spreadsheets, the stock tips. Instead, we're diving into the invisible, psychological forces that are actually dictating your financial destiny. So let's just jump right in with a massive question. Why do smart people stay broke? It's honestly one of the most frustrating paradoxes of modern life. Because the difference between financial struggle and long-term freedom, it has almost nothing to do with your raw intelligence or even the size of your paycheck. I mean, there are plenty of brilliant, high-earning professionals out there who are just perpetually stressed about money. Why is that? Well, as our sources reveal, the real divide isn't income at all. It's mindset. Dr. Brad Klontz, a wealth psychologist, really hits the nail on the head here. He points out that acquiring wealth is an emotional discipline first and a mathematical one second. Think about it. If you view money simply as the final destination or just a way to buy more stuff to prove to everyone that you've made it, you're essentially locked into a middle-class mindset. Wealthy individuals use money the way a master builder uses bricks. They don't just stare at them or show them off. They use them to build something much, much bigger, like security, opportunity, and ultimate freedom. All right, let's get into Section 1, your hidden money scripts, or as I like to call it, the emotional baggage we're all carrying around in our wallets. To really understand our current financial roadblocks, we actually have to rewind and look backward at our childhood programming. Financial psychologists call these money scripts. We all operate on these invisible rules. Maybe you absorbed them by watching your parents argue over bills at the kitchen table, or maybe they were directly taught to you. But here is the absolutely crucial point. Unless we actively identify these hidden scripts, they're gonna silently control literally every single financial choice we make as adults. Now, there are 4 primary scripts, and each one can uniquely trap us. First, you've got money avoiders. They might unconsciously self-sabotage because deep down they think wealth is inherently greedy or corrupting. Then you have money worshippers. They're chasing a finish line that doesn't even exist, buying endless things just hoping for a hit of happiness. Next are the money status believers. They totally equate their self-worth with their net worth. It's like an addiction. They constantly need the newest, flashiest, big-ticket item just to prop up their self-esteem. And finally, even the seemingly responsible script, money vigilance, can trap you. Believing there is never enough leads to a cycle of never feeling truly secure, resulting in profound anxiety no matter how much cash is stashed away. So ask yourself, which one of these is quietly running your life right now? Moving on to Section 2, consumers versus investors. We're looking at a fundamental shift in emotional orientation here. Let's break down how a consumer mindset drastically differs from an investor mindset. It's night and day. Consumers spend for a quick mood boost. They'll go buy a new car or an upgraded home for immediate emotional relief, stress reduction, or just social signaling. But the catch? Those things depreciate or lock them into suffocating monthly debt. Investors, on the flip side, spend to acquire lasting leverage. They buy equity, they buy businesses, they buy real estate. They accumulate things that actually pay them. And this completely flips the script on the questions they ask themselves before making a move. Consumers operate on what we call paycheck thinking. They look at a purchase and ask, hey, can I afford this monthly payment within my budget? This is exactly why even high earners get trapped in the paycheck-to-paycheck cycle. They optimize for immediate lifestyle upgrades. Investors, though, operate on cash flow thinking. They look at that exact same pile of money and ask, will this capital allocation generate a sustainable income stream for me over the next 2 decades? That brings us to a massive differentiator, how these two groups actually experience time. Consumers absolutely demand short feedback loops. They want visible, instant rewards because to them, waiting just feels like deprivation. It's painful. Investors, however, have built up an emotional tolerance for discomfort and uncertainty. They'll happily drive a 15-year-old beat-up Honda just to allow their capital to compound in the background. See, investors don't view delayed gratification as a sacrifice. They frame it as a highly empowering choice to go out and buy their future freedom. All right, Section 3, sudden wealth syndrome. This is the ultimate proof that wealth is, at its core, a psychological state. If you're still sitting there thinking wealth is just about getting handed a huge check and being set for life, well, wait until you see what happens when the mind is totally unprepared for the money. Without an investor's emotional regulation, an unexpected fortune, like an inheritance or hitting the lottery, frequently devolves into a full-blown identity crisis. Wealth psychologists map out the life cycle like this: Day one, it's just shock and paralysis. Fast forward a few weeks, paranoia sets in. People develop an intense fear of losing it all, obsessively checking their accounts in a state known as ticker shock. By month 6, unconscious survivor guilt kicks in. This leads to massive self-sabotage, hastily giving money away to opportunistic friends, and deep social isolation. And sadly, by year 5, the wealth is very often completely gone. Think I'm exaggerating? Get this. In one really famous study from the Review of Economics and Statistics, they tracked 35,000 lottery winners. An astonishing 1,900 of them filed for bankruptcy within just 5 years. Let that sink in. That is absolute, undeniable proof that money without the proper psychological mindset simply evaporates into thin air. So let's pivot to Section 4, Strategic Leverage and Growth. Let's look at the actual mechanics of true wealth. Okay, so if we know we need to hold on to our assets and let them compound, what do the truly wealthy do when they actually need cash for life's big expenses? Well, the average person's knee-jerk instinct is to just sell their investments. But if you sell your assets for cash, you trigger a taxable event. We're talking a massive 20% long-term capital gains hit. Ouch. And honestly, even worse than the tax bill is that you permanently kill the future compounding earning power of those assets. The second they're sold, they stop working for you forever. So, instead of selling off the golden goose, wealthy individuals use leverage strategically. They intelligently borrow against their assets at low variable rates. Say they need to pay a massive tax bill or bridge a gap until a bonus hits, they might pull from a securities-based line of credit at their bank. Want to buy the dip in the stock market? They use a margin loan. Want to drop an all-cash offer on a real estate property? They'll tap into a home equity line of credit. By strategically leveraging their assets this way, their core investments just continue to grow completely uninterrupted, totally outpacing the cost of the loan's interest over time. It's brilliant. Finally, let's wrap up with Section 5, the stewardship of wealth. This is all about finding a higher purpose for our capital. Let's completely elevate our perspective for a second. What is the ultimate purpose of all this financial growth? Well, let's look at how Islamic psychoeconomics entirely reframes the very concept of absolute ownership. In modern capitalism, we're taught from day one that we own our wealth. It's ours. But in the Islamic worldview, you are not the true owner of your wealth. You're actually just a trustee. God is the owner, and your job is to manage those assets according to the terms of the trust. This creates a fascinating psychological shift. If you are just a trustee, well, the ultimate long-term investment isn't a brokerage account at all. It's charity. It's about building a beautifully diversified akhira, or afterlife investment portfolio, allocating percentages of your wealth to mosques, education, poverty relief, and the environment. And the craziest part? The best practices for this spiritual stewardship perfectly mirror the best practices for worldly investing. You invest early and consistently, letting those spiritual returns compound over a whole lifetime. You take calculated risks, donating to righteous community projects when they are in their most vulnerable early phases, because that's when the impact and the reward is the absolute highest. And you diversify your giving across different sectors of society. By reframing wealth this way, you realize a pretty profound truth. The only wealth you actually keep forever is the wealth you give away. I really want to leave you with this one provocative thought today. Take a hard look at your financial life. Does your bank account merely measure your purchasing power, just what you can consume today? Or does it reflect your deep internal mindset, your tolerance for delayed gratification, and your ultimate stewardship of the resources you've been given? Change your emotional relationship with money today, and your financial trajectory is going to completely transform tomorrow. Thanks so much for joining me on this explainer, and I'll see you all next time.